So 2017 was a tough year for annuities. Sales were down to about $203.5 billion, which is down about 8%. Can you tell us a little bit about what's behind those numbers?
Yes, 2017 was really a dynamic market in the individual annuity space. We saw a lot of change. We had the initial DOL fiduciary rule that went into place on June 9th, and this caused a lot of hesitation in the marketplace itself.
So, indexed annuities. They bounced back in the fourth quarter. How do you see the future looking?
Yes, the indexed annuity market was one of the most impacted space with the DOL fiduciary rule. There was a lot of uncertainty as we entered into 2017, and with the delay of the DOL fiduciary rule, that brought some clarity to the marketplace itself. That caused the bounce back in the fourth quarter, which helped the market. And as we move forward with this clarity, we do expect sales to rise in 2018.
So what about income annuities? We know that more than 10,000 people are retiring every day, so you would expect that the market for those would be just growing, but that doesn't seem to be happening. What do you think it'll take to get traction in the marketplace?
Demographics are in favor for income annuities. They're the most efficient way to provide guaranteed lifetime income for people in need. But really what's hampered the growth has been the environment that we're in. We've had low interest rates for nearly a decade, but these low interest rates have dampened the value proposition of income annuities.
While fixed annuity sales are still dropping, they're exceeding VA sales. What's behind that?
And when we looked at the fixed annuity market, we've seen growth 4 out of the last 5 years. Now, we did see sales drop in 2017, but sales still remained over $100 billion. And this is 3 consecutive years with sales over $100 billion, which we've never seen in the marketplace before. You have indexed annuities that have been driving the fixed annuity market and now make up over half of fixed annuity sales. When you combine this with the pressures and headwinds on the variable annuity market, and we struggle to see a catalyst for growth in that space, we do expect fixed annuity sales to continue to exceed variable annuity sales moving forward.
So the first part of the DOL implementation occurred in June, and that seemed to have a huge impact on the sales of annuity. Can you tell us a little bit about why and then how it affected distribution?
Absolutely. And when you think about it, we have a 1,000-page regulation that came out targeting the industry. It had enormous impacts to the whole supply chain of individual annuity sales. From a distribution standpoint, they really had to make a significant amount of change in their practices and their business models, depending on how they interpreted the rule themselves. This, as we saw with the third quarter sales, brought individual annuity sales down.
Has the delay in the BIC been well received by the industry?
This is kind of a yes and no answer. Yes, in the fact that we have clarity as to what 2018 will look like. We have the delay through mid-2019, so we see business going back to somewhat of a normal state in 2018. But we also have this cloud of uncertainty of what 2019 is going to look like. And when you think about our industry and what the problems we're trying to solve, it's hard for manufacturers and distributors to come up with long-term plans to help people when we have short-term uncertainty.
Yeah, uncertainty is never good for the business. So Todd, it seems like there's an interesting trend these days. So historically, economic conditions and annuity sales have been pretty well correlated. But in 2017, we saw that equities went up, but it didn't really help the VA market. And at the same time, the Fed increased interest rates, and it didn't help the fixed annuity market. What's going on?
Let's start with the variable annuity market. We have to go back to about 2012, where we started to see the disconnect from equity markets and variable annuity sales. You had manufacturers that started carefully managing the tail risk within these products and managing their sales volumes, particularly products with a guaranteed living benefit. Now, layer on the regulatory change of the DOL fiduciary rule, and this has even accelerated the declines, even though the equity market has been increasing. Now, on the fixed annuity side, we've had improved interest rates in 2017, which should have boosted up fixed annuity sales. But when we look a little bit closer, we have 2 factors that are going on. One factor in 2017 was that short-term rates increased at a more rapid rate than longer-term rates. And then we also have the expectations that interest rates are going to continue to rise as we move into 2018. This has the potential for people to stay on the sidelines and kind of wait, because interest rates may be better tomorrow than they are today.
So one bright spot in the marketplace has been structured annuities. They grew 25% in 2017. What do you see as their impact on the market?
When you look at structured annuity products, they kind of fit in between a traditional variable annuity and a fixed indexed annuity. And when you look at the economic environment we're in today with the low interest rate environment, it's really helping Americans that are looking for growth for retirement, but at the same time layering on some downside protection. And it really provides a good balance within that. Now, when you look at the structured market and the growth of sales in 2017, it has helped mute some of the downturn we've seen in the variable annuity market over the past few years.
Do you think sales are going to continue to increase?
As we look into 2018, yes, we do expect sales to increase in the structured annuity space, combined with the fact that we're seeing more manufacturers that will be entering the space in 2018.
So let's think about sales then and the future. It's an interesting environment in terms of regulation. So we know that the DOL rule has been delayed, and we know that at least 4 states have proposed regulation or their own legislation that bans conflicts of interest and requires advisors to adhere to a fiduciary standard. At the same time, it's rumored that the SEC and the DOL are looking at joint standards that would be set out for comment in the fall. How do you think this will affect the sales environment?
When we look forward, we definitely have a cloud of uncertainty based on all of these different proposals or rumors out there on the regulatory environment. One of the bigger concerns is with states moving forward with fiduciary rules on their own, because then you would have 50 sets of unique standards that you would have to adhere to. As we look forward past 2018, we have no idea if we're going to see a DOL rule or a joint DOL-SEC rule. And again, creating an environment of uncertainty moving forward, making it difficult for manufacturers and distributors to move forward with business strategies long term.
So aside from the DOL, are there any other product or distribution trends we should be watching?
As we look into 2018, from a product perspective, we're continuing to keep a close eye on the structured annuity market as we anticipate more players entering this space as we move throughout the year. Now, from a distribution standpoint, we are seeing companies that are stepping outside the norm of distribution of annuity products. And we're seeing a few carriers that are experimenting with direct-to-consumer products. So we'll be looking at that closely. And as we look at 2018, because we have some clarity on what the regulatory environment will look like, we do expect sales actually to hopefully break the trend of declines that we've seen over the last 3 years and grow slightly for the year.
So there are some bright spots, and I think it's very important to see that the industry is looking to innovate or try different types of distribution to make sure that these products get to their intended consumers. So with that, I'd like to say thank you very much for joining us today, and Todd, thank you for your insights and for sharing your predictions for 2018 and beyond. So on behalf of Todd and myself, thank you very much.